Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Tuesday, February 17th, 2026, and we are looking at some fresh market intelligence from yesterday, February 16th.
Well, Ethan, the data we've processed from user discussions yesterday was quite a whirlwind. We saw a significant number of posts flagging a pretty diverse range of stocks.
Absolutely. It feels like the market is really buzzing, There's a fascinating mix out there, with some truly promising opportunities bubbling up alongside some intense skepticism, especially concerning some of the high-flying tech names. It's certainly a market demanding careful consideration. All right, let's jump right into it. And to kick things off on a high note, we've got some very interesting news for Zim Integrated Shipping Services, ticker ZIM. The chatter around Zim has been overwhelmingly bullish, and for good reason.
Oh, it's definitely a standout, Ethan. The user sentiment is a resounding buy. And for once, it's not just pure speculation. We have confirmed news that Hapag-Lloyd has made an offer to acquire Zim for $35 per share in cash.
Exactly. That's a significant premium over its current trading price of $22.20. When we look at the KPIs, you see Zim had an incredibly low price-to-earnings ratio of 2.67 and a price-to-book of 0.67. This acquisition, in my opinion, just really validates that the market was undervaluing Zim's intrinsic worth. This deal looks like it's unlocking that value for shareholders.
Well, let's not forget, Ethan, that Zim was previously rated stay away as recently as January 3rd due to factors like its high debt-to-equity of 140.799 and negative revenue growth of minus 0.357. The acquisition news completely overrides those concerns for current investors, turning it into a clear play. But those past KPIs do highlight the inherent risks before this kind of news dropped. For now, though, the numbers speak for themselves.
Agreed, Brooke. With a confirmed buyout at $35, it's a pretty compelling short-term opportunity for investors.
So, for Zim, our AI-generated insight is a clear buy. Now, let's talk about another interesting situation involving a stock that's caught a lot of attention in the past day. We're seeing posts discussing a company with the ticker WD and also PC, but there's a critical discrepancy here that needs to be highlighted.
That's right, Brooke. The social media posts with a lot of enthusiastic comments are actually discussing Western Digital, WDC, focusing on its impressive news. 100% of its HDD capacity for 2026 sold out, 89% of revenue from hyperscaler AI data centers, and long-term deals stretching to 2028. This clearly points to incredible demand in the AI space.
And that's where the caution comes in, Ethan, because the KPIs we have for Walker & Dunlop, WD, and Premium Catering, PC, which are the tickers flagged, tell a completely different story. For Walker & Dunlop, WD, we're looking at an extremely high debt-to-equity ratio of 171.557, and while revenue growth is solid at 18.1%, the stock has dropped 30% from its 52-week high. Returns on equity and assets are also relatively low at 6.3% and 2.1%. Those are not the metrics of a high-flying tech company, and they signal significant financial leverage and risk.
I see your point. It's crucial to differentiate. If we were looking only at the incredible demand for AI data storage capacity, you could argue for a strong growth trajectory. But we must be careful with our data.
And it's even more stark for Premium Catering, PC, the other ticker flagged with similar mismatched content. Its actual KPIs show profound unprofitability, with a net profit margin of minus 1.266, negative EPS, and an extremely high debt-to-equity of 9.807. Despite the bullish narrative from the mismatched posts, the financial reality for PC is deeply concerning. It was previously a stay-away rating, and these KPIs reinforce that.
Given the critical data mismatch and the actual financial health of the companies associated with the flagged tickers, it sounds like we need to be extremely cautious.
Absolutely. For both Walker & Dunlop, WD, and Premium Catering, PC, our AI-generated insight is to stay away.
Now, let's shift gears to a company that's always a hot topic, NVIDIA, or NVDA. We've seen a surge in discussions, with many anticipating strong Q4 earnings, arguing that the market hasn't fully priced in the incredible growth potential, especially with CEO Jensen Huang's vision of compute power as the new natural resource. Ray Dalio's Bridgewater also reportedly made a significant investment.
Well, Ethan, while the raw revenue growth for NVDA is staggering at 62.5%, the user sentiment analysis and, frankly, the KPIs suggest a more cautious approach. Despite some very bullish takes, many users are expressing skepticism. They point to the trend of other tech stocks crashing post-earnings, even with good results.
But you can't ignore NVIDIA's position at the forefront of AI. That 62.5% revenue growth isn't just a number. It reflects their unparalleled dominance in a revolutionary sector. The partnerships and the sheer demand for their chips indicate sustained growth. And the Dalio investment, even if not huge in relative terms, shows institutional confidence. We previously rated NVIDIA a buy just on February 14th, reflecting this.
I hear you, but let's look at those KPIs. The price-to-earnings ratio is still very high at 45.24, which many users are calling overstretched. The price-to-book is also extreme at 37.36, which suggests that future growth is already heavily baked into the current price. More critically, the debt-to-equity ratio is a hefty 9.102, which is a significant financial risk often overlooked. And let's not forget the insider activity. Net insider selling of almost 1.9 million shares over the last 6 months. That's a major red flag for me, indicating that those closest to the company are taking profits.
So you're saying even with what could be stellar earnings coming up on February 25th, the market might still react negatively due to these valuation concerns and the high bar set? Precisely. The potential for future growth is priced in, making new investments highly speculative without a truly extraordinary earnings beat and a clear path to managing that debt or reducing the valuation multiple. Given the market skepticism and insider selling, our AI-generated insight is a stay away for NVDA for new short-term investments, which is a downgrade from its recent buy rating. All right, that was a busy day, Brooke. Let's recap for our listeners. Investigate as buy. Zim Integrated Shipping Services Limited. Zim. Investigate as cautious buy. None. Investigate as speculative gamble. NVIDIA Corporation. NVDA.
And that wraps up our daily hunt, everyone.
Before we sign off, please remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to the Daily Hunt for Multibaggers. We'll be back tomorrow with more insights.
See you then.